in the chat. I see Minnesota, where it's probably colder than it is here in Chicago. DC, Boston. Philly, where it's snowing, and Los Angeles, where it's not. It's not fair. Give everybody a couple more seconds and then we'll get started. Yeah, Jen, I'm sure it is cold in California. Please. It was 27 here yesterday. Thanks so much, everybody, for joining. I'm going to go ahead and get started. Welcome. Thanks for joining today's ILEA keynote event. My name is Gwendolyn McNutt, and CSCP, and I'm the chair of the ILEA Professional Development Committee. Today, we'll be presenting Minding Your Business, Get Your Financial House in Order in 2021, powered by Giants Enterprises. ILEA is proud to team up with longtime partner Giants Enterprises to create relevant, timely, high-quality webinar content for our community as we support our industry through recovery. Giants Enterprises is dedicated to the curation and development of new ventures complementary to the San Francisco Giants franchise by delivering larger-than-life experiences to millions at Oracle Park and beyond. Giants Enterprises creates memorable events abundant with excitement and engagement, both virtually and in person, for their varied partners as well as local and international visitors. Positioned at the intersection of sports, entertainment, meetings, events, tourism, and hospitality, Giants Enterprises provides a rare combination of people, experiences, and platforms necessary to create Giants impressions. Thank you again, Giants Enterprises. And just a couple of housekeeping things before we get started. We will be recording today's session, and it will be posted on the ILEA Hub. If you have any questions during the presentation, please type them into the Q&A, and we'll try to get to some of them at the end of our talk. Also, please share your thoughts and comments in the chat. And please share your experience on social media using the hashtags ILEA Webinar Wednesday and ILEA Welcomes All. And we're very excited to bring you today's presentation. As with all our educational opportunities, we hope you come away with some new ideas, new perspectives, and strategies to apply to your own businesses and careers. Today's keynote speaker is Ken Alozie. Ken is a SCORE mentor where he helps small businesses write business plans and navigate capital resources for their companies. He is also a regular contributor to major media outlets on behalf of SCORE. He also serves as managing director for Greenwood Capital Advisors, LLC, where he helps small businesses obtain a variety of capital necessary to fuel growth, including SBA financing, credit lines, work capital loans, business acquisition financing, and real estate financing, to name a few. For over 20 years, Ken has helped companies use capital to grow, first on Wall Street and now for Main Street companies. He holds a master's in finance from London Business School, an MBA from the University of Michigan, and a bachelor's from Loyola Marymount University. Please welcome Ken Alozie. Ken?
Great, thank you, Gwen. Welcome, everyone. I'm going to share my screen here so you can follow along. As Gwen said, my name is Ken Alozie. Today, we're going to talk about minding your business, get your financial house in order next year in 2021. As she mentioned, I am a mentor for SCORE. SCORE is a resource partner for the SBA, and we basically provide free business advice and mentoring. For more information, visit score.org. Gwen went into my background, and today what we want to talk about is how you can best position yourself to not only receive capital, but to grow your business next year. So involved in that is we talk about keeping good financial records, growing your cash flow, identifying when you actually need a business plan, understanding different capital options like bank loans, crowdfunding, grants, and more, and then repositioning your business in this post-COVID environment. So as an introduction, we've all seen in some version the small business failure rates. According to data from the BLS from 2010 to 2019, about 20% of US small businesses fail within the first year. By the end of the fifth year, that jumps to 50%. And after 10 years, only about a third of small businesses survive. So why do small businesses fail? Cash flow problems usually end up being the #1 reason for small business failure. And that can encompass a series of things like poor records, lack of access to capital or funding, and maybe just general mismanagement. So our goal today really is to give you some strategies so that really to maximize your chances for success as a small business, hopefully avoid some of those pitfalls that many small businesses experience, and help you position yourself to succeed. So what do we mean by records? Keeping good records, this will enable you and those outside of your companies like banks, like angel investors, other types of capital providers to assess the health of your business. So usually when people think of records, they think about financial statements like your profit and loss statement, which is your P&L or income statement, your balance sheet or cash flow statement. So we'll talk about that in this presentation. But what a lot of small business owners tend to not think about are managing their bank statements responsibly, tax returns, and also their own personal financial statement, which is basically a summary of their personal assets and liabilities. So we'll talk about that as well. So we're going to start by talking about why these things are important. So when you're applying for a loan, a bank is usually going to request some combination of these statements here in order to assess your business, assess if your business is healthy or not, and decide whether to approve you for a loan or not. So depending on the type of loan that you're applying for, the size of the loan, they're going to request some combination of these: tax returns, financials, your current debt schedule, a business plan, bank statements, personal financial statements, your credit report. So because these are common items that are typically reviewed by banks, it's really important to know what they're looking for, and also how to keep these in tip-top shape so that whenever you're looking for funding or anything else, you already kind of have your ducks in a row. So we'll start with bank statements because these are typically, in my experience, neglected the most. Bank statements are important because they're one way to evaluate your business income and expenses. If you're applying for a loan, many lenders, they'll want to see at bare minimum your last 3 months of full bank statements. And what they're looking for are trends, seasonality. They want to see if you're making other debt payments. They want to look at your beginning versus ending balances. So they're trying to get a feel for, is your business growing over time, or is it simply just kind of using funds over time? They're very important for small businesses in particular, because usually small businesses may not have the infrastructure to have a CPA or a CFO who's putting together professional income statements, balance sheet, cash flow statements, things like that. So bank statements are even more important for small businesses. So it's really important to, one, have a separate business bank account and only use it for business expenses. It's a red flag for a lot of bankers if they see personal expenses being run through your business. So you want to keep those clean. Really be careful of non-sufficient fund fees and overdraft fees. Some lenders will automatically deny your loan if they see overdrafts. So I know for some lenders, if they see 3 overdrafts over the last 3 months, you're automatically declined. Even if you have good credit, even if other things are positive, they'll automatically decline you. So you want to be responsible with your business bank account. The other thing is tax returns. If you're applying for, an SBA loan, or if you have a potential investor who wants to invest in your business, or other purposes, usually they will request a tax return, and up to 3 years. And what they'll typically look to do is they'll look at what you've reported for sales and income and expenses. They'll add back certain non-cash items, like depreciation and amortization. They'll add back interest expense to try to arrive at a cash flow before debt payments figure. So like an EBITDA or cash flow number. And EBITDA we'll go into later, but it's just your earnings before interest, taxes, depreciation, and amortization. And so for a lot of loans, banks usually want to see up to 3 years, or really at least 3 years of company tax returns. If you don't file separate company tax returns, they'll want to see individual returns plus your Schedule C. And so with tax returns, you want to make sure to file them every year. You wouldn't believe how many businesses I've come across who haven't filed in 2 years or in 3 years. Owing the IRS money because maybe you have unpaid taxes from a particular year won't necessarily disqualify you from being funded if you're on a payment plan. So if you do owe taxes, especially if you're looking for funding for your business, you want to get on a payment plan ASAP, and be mindful of over deducting expenses. You'll see a lot of business owners almost over deduct, sometimes run personal expenses, categorize those as business expenses to minimize their tax liability. The downside is if you have a bank using those to assess your cash flow, which flows into the amount of loan that you qualify for, that's going to be somewhat lower than it should be. The other thing is, I've also seen instances where people are selling their company and they've done the same thing, made over deductions. And so a company that maybe has $1 million a year in cash flow, they're reporting 700,000, but the bank and the person buying your business has to go by that 700,000 when they're arriving at a value for your company. So really be mindful of over deducting on your tax returns. The next record we want to talk about is your PFS, or your personal financial statement. If you're applying for an SBA loan or anything like that, they'll typically request this, and it's basically just a summary of all your personal assets and liabilities. And so examples of your assets might be investments or equity in real estate, automobiles, retirement accounts, and liabilities might be a mortgage or credit cards. And then your net worth is just your assets minus your liabilities. For some loans, like SBA loans that require collateral, they'll look to see that the assets that you've listed are as close as possible to the amount of loan that you're requesting. So if you're trying to get $1 million loan, but your net worth is only $50,000, you only have $5,000 in liquidity, you're going to have a very hard time getting that loan. And so it's really used as a way for the bank to determine if you have enough collateral for the loan that you're applying for. I always advise completing a personal financial statement before you need one, just so you're familiar with it and don't make mistakes. I've seen some people um, make addition and subtraction errors when they're calculating the net worth and all of that. So you want to do one before you need it and have some practice, because again, the bank isn't only assessing your business, but they're assessing your ability and your competence as a business owner. So you don't want to submit anything, including that, with mistakes. And then we'll get into financial statements. So broadly speaking, there are three major financial statements. One is the balance sheet, which is basically a snapshot of your company's financial position at any point in time. And so it shows your assets, what you own, versus your liabilities, or what you owe. The other one is your income statement. It's also referred to as your profit and loss, or P&L statement. It shows your income versus your expenses for the period. The third one is a cash flow statement. You're not going to see this used as much for small businesses, but for larger businesses, because the income statement may include, maybe using accrual accounting and maybe deducting non-cash expenses. They may also complete a separate cash flow statement so that you get an idea of how much cash is actually going in and out of the business. And so your balance sheet, again, it's your assets versus your liabilities. You want to make sure it balances, that your liabilities plus your owner's equity equals your assets. I have seen some in my day that don't balance, which is, again, a red flag. Here's some examples of various assets and liabilities. If you're doing accrual accounting versus, say, cash accounting, you're going to have some of the items on here like accounts receivable. Accounts receivable are basically revenues that you've earned but haven't been paid for yet. So let's say you have a government contract, you've done all the work, you bill the government, and then you're waiting to be paid in 30 days or in 60 days. That would go into your accounts receivable. P&L statement, basically your income statement. It's going to be a function of your top line sales minus your cost of goods sold, or the cost of generating those sales. So cost of goods sold may include the cost to make a good, or the associated direct labor, projecting any other operating expenses like salaries and rent, and then calculating either a profit or a loss. And then the cash flow statement we've talked about. Most small businesses aren't going to use this, but you'll basically calculate your cash flow from operations, investing, and financing, take a net number, and that'll show the net cash going in and out of your business for that period. But if you're a small business, what's more important really is your EBITDA. And it's much more common than a cash flow statement because it's faster and easier to calculate. And it's just your earnings before interest, taxes, depreciation, and amortization. This number can impact the size of funding that you get. It can impact how much someone is willing to pay to buy your business. And so banks are going to look at your financial statements, whether it's your P&L or your tax returns, maybe even your bank statements, and try and calculate your EBITDA. So it's not a bad idea for you to know what your EBITDA is and calculate it yourself so you can speak to it intelligently. If you're a new business and you're putting together a business plan, or you're seeking funding or investors, or really just for your own personal planning, you want to be able to project your startup costs. It may take some months before you actually have revenue coming in. So you want to know the expenses that are going out from month to month, or what's often referred to as your burn rate, before you actually have revenue coming in. Because There are a lot of reasons for that. The main reason is you want to know at what point you're going to either exhaust your own personal savings or when you're going to need outside capital to fund your business. So if you're, and the other thing with the burn rate as well is if you're looking for funding from, say, an angel investor or venture capital firm, they want to know, hey, if I invest $1 million or $2 million, how long is it going to take before your company eats through that? And is that going to be enough for you to make it to profitability? So this is a really, really important part of your own business financial planning, especially if you're a startup. So some other basic startup costs to remember, before you even generate revenue, if you need a brick and mortar space, you're going to have lease payments. You may have labor or salaries. You may have to buy equipment or inventory. There may be costs associated with putting up a website. So all those things you definitely want to consider when you're figuring out your startup expenses. A term you'll hear a lot is working capital. Working capital is really just money that that you have to go towards expenses as they come up, or to have as a cushion. So if you're putting together a business plan because you're going to go to a bank to try and get an SBA loan, or you're going to try to go to investors, you definitely want to figure out how much cash you're burning through every month, and then how much of a cushion you want on top of that, just for expenses that might come up that you don't foresee. Next, we're going to talk about where do you get money for your business. So here's some common uses of business funding. One of the most common is to fund day-to-day operations and funding gaps. We talked a little bit before about accounts receivable, but especially if you're in a business where you have to do the work before you're paid, like a government contractor, that creates a funding gap, because in the meantime, while you're waiting to be paid, you still have to pay employees, you still have to pay rent, you still have to pay for materials. And so it's important to either have working capital as savings, or access to, say, a line of credit that you can tap into for those funding gaps. Other uses are buying inventory or equipment, buying real estate, either owner occupied, which is going to house the business, or investment real estate. You can get business funding to buy another business or a franchise. Another common use is to refinance existing debt, especially when rates come down, not dissimilar from refinancing your mortgage. These two charts are really just showing that small businesses are really, when they're planning to grow, they're on average looking to apply for bank loans to fund that growth. So the left set of bars here in green are the percentage of businesses planning to expand in the year ahead. So we've got fall 2016, 2017, 2018, and then the right set of bars in blue is the percentage of businesses planning to apply for a loan. And as you can see, there's a correlation there. And this was based on a study done by Bank of America back in 2018. It's probably, these are probably somewhat different now with COVID, but this is typically what it looks like. At the same time, we've seen over time that even though the number of banks has declined over time, this left set of bars, the amount of deposits held by banks has actually grown. And so, especially since 2008, we've seen the big banks get bigger. And we'll talk about why this is important. As the bigger banks have grown in size, their loans to smaller companies has declined over time. So if you look at this chart, this was done in 2012, and this trend has really continued since then. The green line are large business loans above $1 million. We see that they fell off, post 08, but they started to rebound again around 2009, 2010. But for small and micro loans, the volume of those loans have just continued to decline. And so this is important because I think that a lot of small businesses don't understand why, when they hear that there's all this money out there for small businesses, they don't understand why it's so hard to access capital or hard to get a bank loan. And this is part of that reason. So we'll talk about what small businesses are doing and where they're going. Where you go for capital really depends on, the type of capital that you're looking for, what you're gonna use the funds for, and really the stage of your business. So we'll talk about the startup stage versus new business, mature business, and exit. So if you're a startup, maybe you're pre-revenue, little to no collateral or a track record in the way of financials yet. So you're primarily going to use personal savings, go to friends and family. There's going to be more attention on, say, your own personal credit rather than any business credit, just because it's a newer business. Other routes that startups are taking, depending on the industry, maybe they're going to angels. There's been a lot of growth in crowdfunding, which is basically raising money from individuals through crowdfunding platforms. So we'll talk a little bit about that later. Venture capital, if you're a scalable business, might be an option as well. I say possibly banks because typically for startups, banks usually want to see a business with at least 3 years of history. But if you're a startup, particularly if you're buying, say, a franchise that has an established brand like a McDonald's or a Popeyes, there are a lot of banks who would potentially fund you. They're typically going to structure it as an SBA loan. A new business, as you start to grow, more options open up. You have more banks and more private lenders that are potentially going to fund you. And then as you become more mature, say 10 years or more, then more options open up as well. And then as you think about selling your business, you may want to look into an investment bank that can help with that sale, or a business broker, and other entities. So what's considered a startup? Really, a startup is a business that, generally speaking, under 2 years, or if you've got little or no documented revenue, regardless of when you were formed. That's important because we'll, especially at SCORE, we'll come across businesses that will say, well, I formed the LLC 10 years ago, but have no revenue. I'm not a startup. Well, essentially you are, because you don't have really any documented revenue yet. So a bank is going to look at you as a startup. And just generally speaking, startups typically have limited options, at least for bank financing. And so if you're starting up a business from scratch, ideally you want to come into it with some personal expenses and some personal savings for those initial expenses, like registering your business, building a website, business cards, anything like that. You got the 3 F's, which you'll hear referred to as friends, family, and fools. We talked about angel investors and crowdfunding. Now, grants, there aren't really as many grants as people think there are, especially for startups. But what you want to do, especially if you plan to rely heavily on grants for your business, is you want to use platforms that allow you to search for grants throughout the country, like grants.gov, grantspace.org. There are other ones out there too, just so you can start to familiarize yourself with the types of grants that are out there, so that even if you don't qualify today, you can work towards qualifying over the next year, 2 years, or 3 years. Banks, in the case of SBA loans, and then certain funds like venture capital funds or impact funds could be an option for startups as well. Impact funds typically want to see that your business is going to have some sort of impact, maybe in the region of your business, or within a certain industry. So one thing you want to learn is what people and banks are going to be looking at when they're deciding whether to invest in your business. And for a bank, they're really going to be looking at the 3 C's, and that's credit, collateral, and cash flow. I refer to these as the holy trinity of lending. They're not, it's not Father, Son, Holy Spirit, but if you're trying to get a bank loan, they're almost just as important. For most traditional banks, all three of these things have to be solid in order for them to fund you. Um, and so assessing where you are on the spectrum and what your strengths are as a borrower, it'll just help you to not only have realistic funding expectations, but it'll help you maybe position yourself and play to your strengths when you're in front of a bank or any other type of capital provider. And so, for example, if you have a lower credit score or low collateral or no collateral, it could mean either a lower approval amount or maybe even being declined, depending on other factors of your business. I'm going to spend more time on credit because this is where I see most small business owners really be impacted. I've seen businesses generating over $1 million in revenue a year, not able to get 50,000 in funding, due in part to credit. Particularly when you're a newer business, personal credit is much more important than business credit until your business is really established and generating considerable revenue. I'll hear people say, well, I have a new business and assume that that means that they have good business credit. It doesn't. Business credit is something you have to build over time. And it's a process. You've got to, it can start by taking out, the simplest way to start building business credit is by taking out a business credit card under your business. But doing business with suppliers and manufacturers that report to business credit, things like that are going to help contribute to your business credit score as well. A lot of traditional banks can't even work with you if you have lower than a 680 FICO, even if everything else looks great. So it's really important to get a handle on your personal credit. Some private lenders may be able to finance you if you have below that, if you've got an established business that's profitable. So you definitely want to check your credit score regularly, but definitely you want to check it before pursuing business funding. So you want to pull your report from a reputable credit service. You know, Credit Karma is just one example. But what's nice about some of these services is you can actually see what your FICO score looks like. We all have access to a free credit report every year, so you definitely want to take advantage of that. And then you want to see and address any items that might be bringing down your score. And then you want to revisit getting a business loan once you're at that 680 level, and I'll say 700 for a startup. There are credit repair services out there, but you really want to be careful of those that are promising a quick fix. It's definitely a process. And you want to beware of the ones charging really high fees. I've heard people tell me they paid a company $10,000 for credit repair, which that's definitely high. I think if it's more than a few $1,000s, you know, you definitely want to watch out. If you need a business loan right this minute, you can look into getting a co-guarantor or a co-signer. They usually don't have to be involved in the business. They just have to be someone who meets the financial requirements and the credit requirements of the bank. Collateral, really, it just helps protect the lender by backing the loan. So collateral could be real estate or equipment. If there isn't collateral, then it's an unsecured loan. And then cash flow, typically what a bank wants to see is that, you know, revenue and profit are growing over time. If they aren't, if there's a hiccup somewhere, and we're seeing a lot of that this year because of COVID, you definitely want to be able to explain that and talk about why things are improving, and hopefully ideally be able to show evidence of that. So via monthly statements to show that, hey, we had to shut down for a while, but since we've reopened, we're kind of trending to get back to normal. Know your numbers. So when you're in front of anyone talking about your business, you shouldn't have to look up basic numbers like revenue or cash flow. You kind of want to know those by heart. Again, they're evaluating not just your business, but you as a business person. Other criteria, we talked about net worth and liquidity. The older your business is, usually the better. Most banks have a time and business requirement of at least 3 years. Um, I'll, I'll talk about your skin in the game. Most investors will want to see that you've invested some of your own money in the business. If you're buying a business, they're really going to pay attention to your industry experience as well. If you have prior what are called derogatories, so liens, bankruptcies, anything like that, it's important to just get them out in the open. Don't try to hide them, and just disclose them up front. Hey, I filed for bankruptcy 7 years ago, but it was cleared 4 years ago. Is that going to preclude me from getting this loan? I've had other clients do that, um, and I was able to get them funded anyway. But if you try and hide it, and then it comes up in their underwriting, and it will, it just destroys your credibility. With COVID, there was a period where a lot of banks weren't writing new loans. That's changing now, but they do want to talk about how COVID has impacted your business. If you're buying a business or starting a new business, in your business plan, when you're making your projections, you definitely want to have projections in there that factor in COVID. So if you're a restaurant, you may want to have one set of assumptions assuming fully open, and another set of assumptions assuming that the majority of your revenue is going to come from carry out or delivery. And ideally, you can cover the loan that you're looking for under both scenarios. And then when you're asking anyone to invest in your business, just really, you want to put yourself in the other person's shoes and be ready to communicate why, not just why you've got a great business or business plan, but you really want to remember that they're looking not just at your business, but they've got a file of dozens of other businesses that they're looking at, and they're basically looking for a reason to say no. So you really want to sell your business and practice your elevator pitch and really know your numbers. We'll talk a little bit about the SBA, since for most businesses, that's going to be something that they, particularly for new businesses, that they look into for funding. So the SBA program was really created to increase capital access for small businesses. The SBA doesn't actually make loans directly. The only exception to that is the recent EIDL, or the disaster relief loan. But for their flagship programs like the 7A and the 504, they're making those loans through participating SBA banks who were underwriting those loans according to SBA guidelines. So that said, all SBA lenders are not created equal. They're going to have their own kind of guidelines, requirements, industry preferences. Some of them will like certain industries like gas stations, franchises. Some of them may not. So you definitely want to have a conversation if you're looking for a business loan, research a few, and then have a conversation and make sure that they fit what you're looking for and that you fit what they're looking for. So the flagship program of the SBA is a 7A program. This can be used for working capital, inventory, equipment. It can be used to buy a business for loans up to $5 million. Any loan under $350,000 is going to be an express loan with lower documentation requirements. 504 loans are really loans that involve big real estate transactions, so maybe owner-occupied real estate or real estate development. So those loans can be much, much higher, but most small businesses are going to be looking at the 7A program. And again, we went through this earlier, but if you're applying for an SBA loan, they're going to most likely be looking to receive all of these documents. You can't use an SBA loan if you're a church or religious institution, a not-for-profit, financial company, network marketing, things like that. We talked about express loans. Not all SBA lenders will do express loans. So if you're looking for a loan below 350, you want to make sure that that bank that you're talking to is going to be able to do an express loan. For really small loans, 500,000 to say maybe 50,000 or so, those are usually offered by CDCs or community development corporations, which are usually not-for-profits and will lend to lower income borrowers or in lower income communities. So if that's what you're looking for, more of a smaller loan, you definitely want to look into an entity like that. Non-SBA loan options, if you're a startup that's just looking for a little bit of funding to get started, business credit cards can be a great way to address that while starting to build business credit. So you want to reach out to your local bank and see what they can offer you. There are also business credit card programs that can help you aggregate funding up to $150,000. And so we've got some programs like that. Crowdfunding is growing. You definitely want to spend time looking through different crowdfunding platforms if that's something that you're interested in. They're all going to be somewhat different, and there are going to be certain nuances with working with one versus another. What else do we want to talk about here? But most of these loans on the left side are for established businesses that have at least 3 years of history. And then in closing, thank you all for participating today. Hopefully you found it helpful. If you have any follow-up questions, we'll reserve some time now for that, and feel free to reach out to me via our company website. If you've got additional questions, if you're interested in finding a mentor through SCORE, again, that's score.org. And at this point, we'll take any questions that you have.
So there's a question in here right now. It says, can you clarify the difference between cash and accrual accounting?
So cash accounting is just recording revenue and expenses as they come in, and accrual accounting is recording them as they're earned. So if I have let's say I'm a government contractor, I do work for the government, we finish, I bill the government for $1 million. If I'm doing accrual accounting, I'll record that as revenue now. If I'm doing cash accounting, I'll actually wait until I receive that $1 million, and then I'll record it as revenue.
So while we're waiting, I just asked if anyone has any additional questions, please add them to the Q&A. But I wrote down 2 questions. You talked about a lot about lenders and things like that, and I was wondering, is relationship building with lenders important? And if you're a small business, how do you go about doing that?
Absolutely. It's always really important to build relationships with any type of advisor that could potentially help your business either now or in the future. So that includes lenders, that includes attorneys, CPAs. And the best thing to do is just to first do your research. I always tell people to start with where they currently bank, where you have a relationship, and just tell them, hey, walk in, make an appointment, say I've started a business, I'm interested in getting some capital, or I just want to build a relationship because I may be back here in 6 months or a year. And it just helps to put a face to a name. And you want to start building those relationships, before you need them, just because they're more likely then to answer your phone call, to answer your emails. And you may want to reach out to a couple other banks as well, and reach out to the ones that are a good fit for you and for your business.
So we have a question here. What is the best way to store records? Do we need to keep hard copies or keep it in the cloud?
You can do either or both. It's really going to be what you're most comfortable with and what you're going to be consistent at doing. Now, if you have other people in your organization that have to contribute to that, like a CPA or a bookkeeper, you may not want to have everything be physical, just because it's going to be more cumbersome to share information amongst each other. So I think ideally you do something, it doesn't have to be in the cloud, but you may want something electronic, whether it's QuickBooks or something else, just to facilitate sharing throughout your organization.
And we have another question here from Carl. Does SCORE offer advice or mentoring for budgeting?
Yes, they do. Just when you're requesting a mentor, just specifically state that that's the advice that you're looking for, and they'll do their best to match you with an experienced mentor in that area.
I have another question that I wrote down here is, what's your advice for businesses in industries like ours, like live events that essentially had to shut down? So, how do we approach, the whole financial assistance or loans or something like that in an industry that's in some cases not working?
Yeah, that's a tough one. I mean, that's a loaded question. I won't be able to give a full answer
I wasn't trying to
in a
load it,
minute,
but
but but I'll tell you what a client of mine did. He was in kind of a related business, and what he did since business slowed down is he said, "Let me take this time and reach out to other people in my field because I know that they're experiencing something similar, and let's share ideas. Let's find out what other people are doing." And through that, he expected to get pushback because they're essentially competitors. But what he found was that people were willing to not only share, but now he's got future potential partners and advisors. So that's one thing that you can do is just kind of reach out to others in your industry and share ideas. But you definitely want to take this time to build relationships because as you start to re-enter the market, um, those are relationships that you can tap into as things turn around.
well, I don't see any additional questions in the chat, but as Ken said, if you do have questions, you can, reach out to him or to me, and I can get the information to him. I just want to thank you, Ken, for being our guest and doing our presentation today. Thank you again to Giants Enterprises, and thank you to all of you for joining us. This was our last ILEA webinar for 2020. So we hope to be bringing you much more quality education in 2021. The committee is already lining up some great topics for January. So look for that coming out shortly. And we thank you for joining us today. Thanks so much.
Thank you.